Good morning. I have come with the new module Computation of Capital Gains. So we have learned so far computation of income from salary, computation of income from house property, computation of income from business or profession, and this is the fourth head of income, that is computation of capital gain. Now one more head of income we have to learn, that is income from other sources. So I told you in the beginning itself we have 5 heads of income. So if you learn all the 5 heads of income, our computation will be completed. Tax computation, different 5 heads of income. So we have reached the fourth head of income, that is computation of capital gain. So when I explained the distinction between capital and revenue, I told you if it's related to capital asset, we will take only in the capital gain chapter. So that is very, very important. Capital gain chapter only we are taking that. So here, what is a capital asset? This is just the first module is just the theoretical concepts I'm going to explain. What is a capital asset? What is short term capital asset? What is long term capital asset? What is short term capital gain? What is long term capital gain? And just two problems: cost of indexation, improved cost of index cost of improvement, index cost of purchase. All these details, the basic concepts I'm going to explain. So this will be clear, and just two problems just to illustrate the basic concepts. So how I have designed this module is, please remember that just one or two problems in each module I will include, because almost all the problems we have different sections in the full problem. So one module, the last module for this chapter, I will include for computation of capital gain. In that, various sections will be included, because why I am talking about various sections is there is section 54 that will give certain exemptions for investments using capital gain. See, if you sold a house property, you made a capital gain. If you can invest in another house property, then you can get that exemption. So these are all explained in section 54. So one problem will consist of 2-3 items. When you're doing the full capital gain problem, 2-3 adjustments will be there. So you have to remember the 2-3 sections will be there. So one module I will exclusively devote for computation of capital gain with different sections. So when I'm explaining the basic sections as introductory module, I will explain just one or two problems. So that will be helpful for you to understand the concepts. So the final computation we are going to do at the end. So that is how I have designed that, and you will find it really useful and helpful. So this I am going to explain with the help of PowerPoint presentation, and I am inviting you to learn this module. This is also a very simple module. It's not at all difficult. And I hope that so far, if you are following these YouTube videos, you will find that this is a simple calculation and simple explanation. Everybody can understand this. So happy learning. We will learn these concepts, just the theoretical concepts of capital gain computation, and just two problems, that is index cost of purchase and index cost of improvement we are going to do. Just two problems to illustrate the concepts. What are the conditions for taxing capital gains? So 5 conditions are there. First condition is there must be a capital asset. Now we will come to that point. What is a capital asset? Capital asset meaning it can be a plant, it can be a vehicle, it can be jewelry, it can be shares, anything. We are coming to that explanation in the next slide. It can be a building, it can be anything. I will explain that with the next slide, where we are explaining the capital asset. We are going to the detailed explanation. Now capital asset must have been transferred. That meaning in this previous year, that is 2019 to 2020, the asset is sold to somebody. Ownership is changed. Now next point is transfer happened during the previous year. So that you have to remember that this previous year only we are taking 2019 and 2020 previous year. Then only the computation will be applicable for assessment year 2021. Now profits or gain arises on such transfer. Either it can be a profit or a gain, or it can be a loss also sometimes. Exceptional cases, it can be a loss also. Now the gain is not exempted under section 54. I told you in the introduction, section 54 is giving you exemptions. Different sections are there. Section 54, section 54B, section 54F, Section 54 EC. So different sections you have to learn. So this exemption is there, meaning this will not be taxed under the capital gain. So that is what we are going to learn. Now, what is the meaning of capital asset? Capital asset meaning property of any kind held by the assessee, whether or not connected with his business or profession. So it can be anything. In the previous slide also I explained. It can be a property, it can be a vehicle, it can be jewelry, it can be shares, it can be building, plant and machinery, anything like that. It may be related to his business or profession or anything which he is keeping as a capital asset. Capital asset, you know that it's not meant for immediate sale. You are keeping it for a long term because you want to use it for a long term. Now, securities held by foreign institutional investors in accordance with the SEBI regulations. See, private placement investment by foreign investors, shares of foreign investors, they are investing in Indian companies. All this can also be called as a capital asset. Now, next is there are certain things which are not exempted, which are exempted as capital asset. See, in general, we can call which an asset which we are using for a long-term use is a capital asset. But there are certain exceptions. These assets are not considered as capital assets. So you have to remember that stock in trade and consumable raw materials held for the purpose of business or profession. Here you have to remember that a business person, when he is doing business, continuously he has to stock that stock. See, stock or raw materials. Raw materials, if it's a manufacturer, raw material will be coming, he will be converting it into finished goods. Similarly, when the stock will get exhausted, he will be replacing the stock. So that cannot be called as capital asset. Second one is personal effects, that is movable property held by the assessee or any member of his family, including wearing apparel and furniture. So personal effects, sometimes household furniture when you are selling or furniture used in the business. All these are the examples. Now personal effects should not be jewelry. So it's not jewelry. So sometimes you have to calculate the capital gain for the jewelry. Jewelry you are using or you got inherited from your grandfather or grandmother or parents. After a few years you are selling. If you are getting a capital gain, it will be taxed. Paintings, these are rare paintings are there. Archaeological collections, drawings, sculptures of work of art. Now, second point is you have to remember personal effects can be anything. So that is your collection. You are collecting this and later see now any person that when they are into some problem and all that with the customs authorities or income tax authorities, this rich people, they will collect so many personal effects. So sometimes when the government or the customs will confiscate their property, they will sell that. So people will buy that. It will be very expensive things. So they will buy that. Even if it's a used item, people will be ready to buy that. They will be ready to pay for that. So personal effects, it can be rare paintings, archaeological collections, drawings of famous artists, sculptures of work of art, or it can be jewelry, antique jewelry and all, it will be very expensive. Now agricultural land in India, not being land situated in specific area. If you see, go by explanation, agricultural land situated in a municipality where the population is less than 10,000. So that is not considered as a capital asset. Now, gold deposit bonds issued under gold deposit scheme. This was the scheme announced by the central government. So this is also not considered as a capital asset. Now, deposit certificate issued under gold monetization scheme. This was introduced in the 2019 budget. So this also is not considered as a capital asset. Now, definition of capital asset. See, here you have to remember that I am giving the section. That meaning section if you get a 2-mark question, you have to give the section also when you are explaining what is the definition of capital asset. So capital asset is defined to include property of any kind, whether fixed or circulating, movable or immovable, tangible or intangible. It can be patents, it can be copyrights, it can be vehicle, it can be building, it can be plant and machinery, it can be land, it can be jewelry, it can be shares, anything like that. So the definition you have to remember for 2 marks question. And section also you have to quote. Now 2 types of capital assets are there. One is short-term capital asset, and always we are using the short form STCA, short-term capital asset. Second one is long-term capital asset, or other short form or we are using LTCA. Now, what is short-term capital asset? So usually the definition is an asset held for not more than 36 months. 36 months means 3 years. 2 exemptions are there. One is 12 months and one is 24 months. So that I'm going to explain that in general, if you're talking that short-term capital asset, meaning if an assessee has holded or keeping an asset for less than 3 years, then prior to the date of transfer, then it is deemed as short-term capital asset. That is in general. There are certain 2 exemptions to this. Now, 12 months exemption is there for this rule. That is, however, following assets are held for not more than 12 months shall be treated as short-term capital asset. So in this, the following assets, it's not 36 months, it's only 12 months. One is equity or preference shares in a company, which are listed in any recognized stock exchange in India. So that you have to remember, only listed securities in recognized stock exchanges. Second one is other listed securities. Other listed securities, any listed securities in the stock exchange. It's not only equity and preference shares, other securities issued by any company or any government. Now, units of UTI, Unit Trust of India. Now, units of equity oriented funds. Equity oriented funds. From time to time, you can see advertisements. Different companies are introducing this units of equity oriented funds. The governments are sometimes doing that. So, zero coupon bonds also. So, that is, if these are the assets, they have to, if they are keeping for less than 1 year, then it will be considered as short term. Now 24 months exemption is there, that is unlisted shares and immovable property, being land or building or both held for not more than 24 months. Immediately prior to the date of transfer shall be treated as short-term capital asset. So listed securities, we have seen that it's 12 months, but if it's unlisted shares, it is 24 months, or immovable property. Either it can be land or building or land and building. Then the period of holding is only 24 months to consider it as short-term capital asset. Now, long-term capital asset. The simple definition of long-term capital asset is a capital asset which is not a short-term capital asset, is a long-term capital asset. So, if it's short-term capital asset, anything which is not a short-term, that meaning short-term, we have seen that in general, period of holding is less than 3 years. But in the case of some items, its period of holding is 12 months. In the case of unlisted securities and land and building, it's 24 months. So if it's not coming in this category, it will be long term. That meaning an asset, capital asset held for more than 3 years, when we are calling it as a long term capital asset. For example, if I purchased a flat in 2010, I am selling it in 2015. So period of holding is more than 3 years. It's 5 years. That meaning it's a long-term capital asset. So that is the definition of long-term capital asset. Now, asset which is held for more than 12 months in the case of listed securities. Already we have seen that listed securities, if it's 12 months or 1 year, then it is called as short-term capital asset. Now, 24 months in the case of land or building or unlisted securities. Already we have seen that. Now, more than 36 months in the case of any other assets will be considered as a long-term capital asset. So, this definition is very, very important. You can expect questions, what is short-term capital asset, what is long-term capital asset, distinction also. Now, short-term capital gain and long-term capital gain. So, this is very simple. Capital gain arising from the transfer of a short-term capital asset is a short-term capital gain. See, if a shares, say listed in the Infosys shares, sold and made a profit of 10,000. Period of holding was 11 months or 12 months. Then the short-term capital gain, that will be short-term capital gain. That meaning any gain arising from the transfer of a short-term capital asset is a short-term capital gain. Similarly, any gain arising from the transfer of a long-term capital asset is a long-term capital gain. I told you that flat I bought in 2010. If I'm selling in 2015, it's a long-term capital asset. So if I'm getting a capital gain of 25 lakhs in that, so that is a long-term capital gain. Now, distinction between short-term capital gain and long-term capital gain. The tax rates. Usual situation, long-term capital gain tax, we take it as 20%. And short-term capital gain tax is 15%. But this is good to know this distinction. You will not get questions based on that. You have to remember only 2 rates. LTCG, flat rate is 20% and short-term capital gain or STCG is 15%. But these tax rates you just remember. LTCG tax except on sale of equity shares and units of equity oriented fund. It is 12%, 20%. So 20%. Now, second classification for LTCG tax is sale of equity shares, units of equity oriented funds. 10% over and above rupees 1 lakh. That means up to 1 lakh it's exempted. Shares. So that is why people are investing. They can invest more in stock exchange. Up to 1 lakh it will be exempted. Above 1 lakh it will be only 10%. Now STCG tax is when securities transaction tax is not applicable. Short form you have to remember STT, Securities Transaction Tax. It will be mentioned in the question whether for that securities transaction tax is paid or not. So in that case, STCG will be considered just like any other income, taxable income. And it will be added to our taxable income, and whatever, if my tax rate, tax liability is 30%, I'll be taxed at 30%. If I'm in 20%, it will be taxed at 20%. If I'm at 10%, it will be taxed at 10%. So STCG is added to taxable income and is taxed according to his income slab, tax slab. That meaning when securities transaction tax is not applicable. Next one is short-term capital gain taxes. When securities transaction tax is applicable, it's usually 15%. In general, our big computation at the undergraduate level, we are taking two rates. One is long-term capital gain at 20%, short-term capital gain at 15%. Now, this point, this table is very, very important. Always they will have a question. Distinguish between short-term capital gain and long-term capital gain. Points of distinction, 4 points I am giving. Time duration of the asset. Short-term capital gain, you know that. Usually it's 36 months, but 12 months in the case of shares. You can add that 24 months in the case of land and building also. LTCG is more than 36 months in the case of regular assets and 12 months for shares and 24 months for land and building or unlisted securities. Now tax rate, I told you, short-term capital gain is usually 15%, long-term capital gain is 20%. Now how you compute? Computation we are going to do in detail in the using the problems. Short-term capital gain tax is sale of cost of asset minus expenditure incurred on asset minus cost of acquisition or improvement. Whereas if we talk about long-term capital gain, you will find the index cost of acquisition. That what is indexation? Indexation is two types. Indexation is due to two things. That is, one is inflation. See, for example, if I got 100 rupees today, I can buy certain things. But the inflation effect will be high. After 6 months, if I want to buy the same items with 100 rupees, it may not be possible. It may be 110%. So long-term capital gain, you have to remember that SSC has kept the asset for a long term. So here the advantage is that if you directly cost price minus purchase price, the capital gain amount will be more. So if you are not considering the impact of inflation on that asset, then SSC will end up paying more tax. So people may not report that capital gain. So to help this, what they are doing is they will indexation. We are coming to in detail what is indexation. So that is the point. That is the term you have to remember here, indexing. See, if a property purchased in 2010, so we are selling this in 2019. So what will be the value of that asset in 2019? So that purchase price into this year index is 301 divided by 2010 index. That is how we will calculate. You don't have to worry about this. We are going to do the problems also. The point of indexation is giving importance for two factors. One is inflation, the impact of inflation, and the capital gain. Capital gain, the maximum benefit they want to give it to the taxpayer. So that is how the inflation and the taxability of capital gain. Based on that, we are doing the indexing. Indexing is possible for the long-term capital gain. There is no indexing for short-term capital gain. That is why actual cost price we are taking. Whereas long-term meaning, since they are keeping for long-term, we have to convert the purchase price. If any improvement is made to the asset, we have to convert it in terms of the value of the price of the year of sale. So that is what we are going to do that. And nature, short-term capital gain arises on transfer of a short-term capital asset. This point we have already seen that if it's long-term capital gain, it's related to the transfer of a long-term capital asset. Now, important point you have to remember, in the case of transfer of a depreciable asset, see, sometimes it will be given that furniture used in the business, depreciation was provided. The written down value of the asset is this much. That meaning, even if the asset was held for more than 3 years, it can be 15 years, 20 years, 25 years, we will not consider long term. Always depreciable asset used in business, capital gain will be always short term. This is very important. So this point I am reading it again. In the case of transfer of a depreciable asset used for business, capital gain is always treated as short term capital gain irrespective of the period of holding. If it's depreciable asset, how do you know that whether it's a depreciable asset? In the question, written down value of the asset will be there. Now, full value of consideration. So these are all not important. You will get the full value of consideration in the problem. But this I am giving you for an explanation. It can be in cash or in kind. Sometimes it's like barter system. Explaining one property. Instead of some shares, they are getting. The exchange between the buyer and seller. One person is getting the building, one person is getting some shares in exchange. So it can be in cash or in kind. So full value of consideration is the consideration received or receivable by the transferor in lieu of assets which are transferred. So whatever the value, in your case, the full value of consideration or the sale price will be given in the question itself. If the consideration is received in kind, then the fair market value will be the consideration. I told you a building and other party is getting some shares. So how do you know the value of shares? The market value of the shares we can get from net, newspapers, financial journals, stock market, quoted shares, anywhere you can get the value. So that will be the value of consideration. Full value of consideration does not mean the market value of the asset which is transferred. So it's not sure that always you will get the market value. Sometimes they may sell more than the market value. Sometimes they may sell less than the market value. Now you see the lockdown period. Now most of the buildings they have given on sale, rent and all, but they may not get the market value. Sometimes you can call it as a desperate sale. So people will sell it at a less than the market value. Now adequacy or inadequacy of consideration is not a relevant factor for the purpose of determining the full value of consideration. We have no right to check that whether it's actual value they got it or not. Whatever the value given in the question, we will do the computation based on that. We don't have to comment on whether it's adequate or inadequate and all. That value, whatever is given in the question, we will do the calculation based on that. Now it makes no difference whether full value of consideration is received during the previous year. See, that is why usually if it's a big sale, land or building or anything, huge amount is involved, nobody can arrange money all of a sudden. So what they will do, they will split it into different installments. So that is what next point is saying. Even if the full value of consideration is received in different years, the final transfer of ownership will take place when the other party will get the full payment. So the entire value of consideration has to be taken into account for computing the capital gain, which will be chargeable to tax in the year of transfer. So even if the payment is divided into different different years, when the full payment is made, the ownership will be transferred. That year we will calculate the capital gain. Now expenditure on transfer, this is also important. Expenditure on transfer meaning you have to remember, it is the expenditure incurred wholly and exclusively in connection with the transfer of a capital asset. This point you have to remember. As a practice, what I am doing is sale consideration less expenditure on transfer. Then you will get net sale consideration. All the problems I am going to work like that. Because if an item expenditure on transfer is there, then you will automatically remember this is how you have to calculate that. If that in the format itself we are learning like that. So that is the meaning of expenditure on transfer. Sometimes big sales and all, it's not possible. Just like barter system, they cannot sell that. People are involved, lawyers are involved, stamp duty is there, court fees there, brokerage is there, commission is there. So these are all the expenditure on transfer. Possible expenses related to transferring the ownership. So this is the explanation. It is the expenditure incurred wholly and exclusively in connection with the transfer of a capital asset. So that is why I told you there are certain expenses. You don't have to worry about this. This is just for the explanation sake. In the question, that a clear value will be given in the question. Now this expenditure is deductible fully from the full value of consideration. So whatever the sale price, see for example, sale price is 15,60,000. It is given that expenditure on transfer is 60,000. So 15,60,000 sale price less expenses on transfer 60,000. 15 lakhs is your net sale consideration. That is how you are going to calculate. Now this expenditure incurred should be necessary to effect the transfer. So that they will see the seriousness, how they have incurred that, whether it was avoidable or unavoidable. Now examples of expenditure are brokerage, commission, cost of stamp paper, registration fees, travelling expenses incurred in connection with transfer, litigation expenses, etc. Now, important points in connection with expenditure on transfer: vague claims for expenses are not allowed. We have to show the actual proof. We have to show the actual proof for claiming that. Now, expenditure in connection with transfer need not necessarily be incurred before passing the title. So, even after passing the ownership, also sometimes we may have to protect the ownership. Sometimes some legal dispute will come between the previous owner, or some other family members will file a case, all that. So that even after passing the ownership also, if some legal expenses are there, that also we can be considered. If any deduction is allowed under any other head of income, then this cannot be claimed as a deduction under section 48. Once you are claiming one deduction under any other head, if it's income from other source or house property income, then that deduction cannot be claimed here. Now, payment made to housing corporate society for getting NOC, no objection certificate for the sale of flat, is an expenditure on transfer. Usually in the apartments this rule is there, because some people, they may not pay the maintenance. So if a party want to sell a flat, what they will do, they will give an NOC by the association, owners association. So usually associations will charge a nominal amount. So that also can be considered as an expenditure on transfer, because if you're selling an apartment without this no objection certificate from the association, you cannot sell the flat. So it's an inevitable expenditure. So that is allowed. Now litigation expenses in connection with transfer are allowed. Litigation expenses will be there, sometimes to protect the ownership, or the previous owners will file some case, something like that. Now cost of acquisition, if it is the value for which asset is acquired by the assessee. The simple meaning is the purchase price. So expenses of capital nature for completing the acquisition of title can be included in the cost of acquisition. So that meaning sometimes they may have to similarly say some legal expenses will be there, some other expenses will be there, registration fees will be there, stamp duty will be there, court fees will be there. All this can be included to cost of acquisition, meaning it's nothing but the purchase price of the asset. Now, cost of improvement. Cost of improvement is sometimes when you buy an asset, after some time what you will do some modification to that asset. See, for example, if you're purchasing a desktop. So when you're purchasing a desktop, whatever the price you will get, after some time you want to make some modification to that. So you will spend some amount. That is called the cost of improvement. You modified that by adding certain the certain GB, or by adding certain modifications, adding certain installations. So that is the cost of improvement in the case of the computer. So it can be possible for any item. If you purchase an house property, after few years you may construct some certain extra rooms, some extra repairs you will do, some extra additions you will do to the building. So that is the cost of improvement. So it means the expenditure incurred by an assessee in making any additions or improvements in capital asset. So that is any addition to the room, or any improvement in the working capacity of the machinery, or anything like that. It also includes the expenditure incurred to protect or complete the title of capital asset. Sometimes to protect the title, ownership, you may have to file a case with somebody. So that is the legal expenses also can be there. Expenditure incurred on improvement of a capital asset before April 1st, 2001 is always taken as equal to 0. You have to remember that our indexing is starting from 2001 to 2002. That is the base, that is 100. Now, cost of improvement does not include any expenditure incurred earlier. See, for example, an asset purchased in 1990. Cost of improvement made in 1994. Then our indexing is starting from 2000. So fair market value as on 2000 will be there in the question. 2001 will be there in the question. So the improvement we don't have to consider, because 2001 fair market value will always include the cost of improvement and the purchase price. So any asset purchased before 2001, whatever the fair market value only we will consider. What all happened before the 2001 we will ignore, because fair market value of 2001 will include all the other expenses prior to that. Now, index cost of acquisition. Cost of acquisition meaning it's the purchase price. And why we are indexing? 2 points I explained. To adjust the effect of inflation, and to give maximum benefit to the taxpayer, they have to pay the least tax possible for the capital gain. That is when people will report whatever income actually they incurred or capital gain they got from the transaction. So this first point is, you may find it difficult, but when you will do the problem, this is just the theoretical explanation. What do you mean by index cost of acquisition? It is the amount which bears to the cost of acquisition, that meaning purchase price, in the same proportion as cost of inflation index for the year in which asset is transferred bears to the cost of inflation index for the first year in which asset was held by the assessee, or for the beginning on April 1st, 2001, whichever is later. So 2001 is the base. That is one thing they want to tell. Base index is 100. Another point you have to remember, see that if an asset is purchased in 2000, now you are selling it in 2019. So what will happen? 2090 2000 purchase price will be very less, that very nominal amount. So now if you are selling for a high rate, if you are just reducing selling price minus purchase price, it will show a huge capital gain. You have not considered the impact of inflation. So what you are going to do, you will index that purchase price with 2001 index. So that is how cost of acquisition, that means purchase price divided by cost of inflation index value will be there in your question. So this equation you have to remember that this is the equation. I cannot put it in one line. That is why I put it like this. Equation is like this. This is very important for 2 marks. Index cost of acquisition, and what do you mean by index cost of acquisition, or sometimes how you calculate index cost of acquisition. Similarly, index cost of improvement and how you calculate index cost of improvement. 2 marks questions, it's important. So the equation is cost of acquisition divided by cost of inflation index for the year in which asset is acquired into CII, cost of inflation index for the year in which asset is transferred. I am going to explain with the problem so it will be more clear. Similarly, this index cost of improvement, it's an amount which bears to the cost of improvement. I have explained what is cost of improvement. You purchased a house, after some years you are adding 2 rooms or you are doing some renovation. You are reconstructing the building. So like that, some improvement you are doing. In the same proportion as cost of inflation index for the year in which asset is transferred bears to the cost of inflation index for the year in which improvement of the asset happened. So if an house property is purchased in 2000, you are doing some improvement in 2005. So when we are calculating the capital gain, the improvement, whatever you have done to the asset also should be considered. That also we will index that, because then it will reflect the actual price of 2019, the year of sale. That is the idea of index cost of improvement. So it's calculated using the equation cost of improvement incurred by the assessee. That amount will be there in the question, divided by CII for the year in which improvement happened into CII for the year in which asset is transferred. So this equation also you have to remember. Now the inflation index I have given, financial year cost of inflation index. This for your reference, but usually in the problem it will be there. 2019-20 inflation index is 301. You have to remember that. That also will be there in the question. Now problem 1. Find out the index cost of the following long-term capital assets sold during the previous year 2019-20. Now you have to remember jewelry. Year of purchase is 2004 and 5. Value is 80,000. So 2004 and 5 fair market value need not be given here. If it is before 2001, then only fair market value will come. So that is how these 3 columns, fair market value is not there in the question. Securities 2006 and 7. It's after 2001. So fair market value we will, as on 2001, we will not consider. House property 2010 and 11. Fair market value we don't have to consider. Cost price is there. And plot inherited in 99-2000. Acquired by father in 98-99. 1 lakh. Because this plot is inherited by the assessee. And that meaning cost to the owner is nil, because he is acquired, he got it as a gift from his father. So then cost to the previous owner we have to say. In this case, cost to the previous owner is the father. So you have to remember that father acquired in 98-99. That is why here it is given the fair market value as on 1/4/2001. because not the SSC. SSC has not spent anything. SSC's cost is nil, zero, because he got it from his father as free. So what is the cost to the previous owner? In this case, previous owner is the father. That is why fair market value only for that plot only we have given in the table. Now we are doing that jewelry 80,000. So we are doing the index cost, purchase price indexing we are doing. Index purchase price, index cost we are doing. So that is 80,301 is the, in CIA values is given. 2004 and 5 is 113. 2006 and 7 is 122. 2010-11 is 167. 2019-20 is 301. So here you have to remember jewelry purchase price is 80,000. 301 is this year index that is also given in the question. Now you have to remember that this was purchased in 2004 and 5. That is why 80,000 into this year index divided by the year of purchase. You will get index price as 2,13,097. So when we are calculating capital gain, instead of 80,000, we will reduce 2,13,097 rupees from the selling price. So it's beneficial to the SSC. That is the purpose of indexing. Now securities you have to remember no indexing. The reason is when you are buying a security, already the cost of inflation is already reflected in the purchase price. Because shares are traded every day. Values are available everywhere. It will be available in the newspaper. It will be available in stock exchange net sites. It is possible newspapers, magazines, journals everywhere. So there is no need for indexing for the bonds or the securities because purchase price reflects the inflation. That is how, because every day it's traded, every moment it's traded. Now house property you have to remember 4 lakh is the purchase price. 301 is this year index and this happened in 2010 and 11 they purchased. So 167. So we will not calculate capital gain with 4 lakhs. We will calculate with 7,20,958. Now plot I told you. See, the year in which father got it, the fair market value 2 lakh into 301 divided by 100 because father acquired it before 2001. So the index cost is 6 lakh 2,000. That is the index cost. So this is how you calculate. Now I hope you understood this concept. Just simple calculation. This year index divided by the year in which the property is purchased. And the value, whatever the purchase price given in the question. And here when it's inherited, you have to remember, we will calculate the cost to the previous owner. That's very important that you have to see that. Now, next problem is Mr. R purchased a house on 111. This is to explain index cost of improvement. Now, R purchased a house on 111/2001 for 2 lakh. And it was improved at a cost of 1 lakh. That meaning improvement, cost of improvement. Maybe any addition to the room or any renovation he has done. What will be the index cost during 2019-20 if CIA for 2001-2 is 100, 2010-11 is 167 and 2019-20 is 301. So index values will be there in the question. You don't have to by heart that. Only two values I will always advise the students to remember, that is 2001-2 is 100. That is the year of starting the indexing. And this year index value 2019-20 is 301. Now table showing the computation of index cost. In cost of acquisition is 2 lakh. Index cost of acquisition we have to calculate. This is 2 lakh into 301 divided by 100. So because it's the year is 2001, index cost is 100. So you are getting 6 lakh 2000. Cost of improvement, they had spent 1 lakh. The year is 167. That meaning 2010-11 he has renovated that. So 2010-11 he has renovated that, and that is why 167 we are using. So 1,80,240. So total index cost is 7,82,240. I think this just the general explanation. I hope that it's clear to you. So that what all the basic concepts we can explain, I have explained that. And two problems also we have worked out just to explain index cost of acquisition and index cost of improvement. I told you have to see that whether SSC has purchased it or whether SSC has inherited it. That is very important. Then index cost of improvement. Always you remember two indexing rates. One is 2001, 2 is 100. This year index 2019-20 is 301. It will be there in the problem, but just to be on the safe side, you remember this. So this is only the first module, 9.1, for computing capital gain. Just the theoretical concept, just the introduction. I hope it's clear to you, and we are going to split it into small modules. So the next module is how we are going to calculate the short-term capital gain and long-term capital gain. So I'm going to explain 5 problems and I'm going to make it very simple. So you'll find it really easy. So that is what we are going to do in the next module. Thank you for watching, and please give me your valuable feedback and suggestions. Thank you.